Friday, December 20th, 2025. Silver closes at $67.30 per ounce. For most people, that's just a number. For traders at JP Morgan, that number represents the beginning of a nightmare. Right now, somewhere in the upper floors of their Manhattan headquarters, analysts are working through the weekend, risk models flashing red, emergency calls to executives, because JP Morgan holds the largest short position on silver in COMEX history. And that position is now underwater, deep underwater. What you're about to learn could change everything you thought you knew about financial markets. A $75 gap up on Monday opening is now confirmed by technical models. Welcome to Silver's Black Monday. This isn't speculation. This isn't fear-mongering. This is mathematics, market structure, and the inevitable consequences of manipulation meeting reality. In the next 20 minutes, I'm going to show you how JP Morgan built a position so large it defies logic, why they're now trapped with losses exceeding $7 billion, the exact mechanics of what happens Monday when Asian markets open, and why this could trigger the biggest short squeeze in commodity history. Everything I'm about to tell you is backed by publicly available data, regulatory filings, and documented market behavior. Pay attention, because what happens in the next 72 hours will be studied in finance textbooks for decades. Let's begin. To understand why JP Morgan is trapped, you need to understand how the paper silver market works, the COMEX, the metals division of the Chicago Mercantile Exchange. This is where silver futures contracts are traded. A futures contract is a promise to buy or sell silver at a future date at a price agreed upon today. Simple concept. But here's the critical part most people miss. Most of these contracts never result in physical delivery. They're cash settled or rolled forward to the next month. It's a paper market, largely disconnected from the actual physical metal. And this disconnection? This is exactly what allowed JP Morgan to build a position that now defies all logic. According to the Commitment of Traders report published weekly by the Commodity Futures Trading Commission, large commercial banks hold massive short positions on silver. JP Morgan, as the largest U.S. bank by assets, is historically the biggest holder of these positions. The exact numbers are hard to pin down because individual positions aren't disclosed, but analysts who have tracked this data for decades estimate JP Morgan controls between 30 to 50% of all commercial short positions on the COMEX. We're talking about hundreds of millions of ounces sold short. What does selling short mean? It means JP Morgan sold silver futures contracts they don't actually own, betting the price would fall. If the price drops, they buy back the contracts cheaper and pocket the difference. Profitable strategy in a falling or stable market. But if the price rises, losses are theoretically unlimited. Every dollar increase in silver price represents millions, potentially billions, in losses on paper for the bank. In 2020, JP Morgan paid $920 million in fines for precious metals market manipulation. The Department of Justice documented years of illegal practices, including spoofing, a technique where the bank placed fake orders to manipulate prices. This record fine confirmed what independent analysts suspected for years. The silver market is manipulated by big banks, but the fine didn't end the short positions. It just made them more visible. The current situation is unprecedented. Silver has gained over 128% since the start of 2025. It broke through its old all-time high of 50 set in 1980. It kept climbing despite repeated margin hikes by the CME. Every attempt to suppress the price has failed. The short sellers are losing control. And JP Morgan, with its outsized position, is at the center of this storm. Let's analyze the math of this trap. Assume JP Morgan holds a net short position of 150 million ounces. That's a conservative estimate based on available data. At an average entry price of $25 per ounce, approximately the average price over recent years, the position was initially profitable, or near break-even. But at $67 per ounce, the unrealized loss is $42 per ounce. Multiply that by 150 million ounces. You get $6.3 billion in losses, and every additional dollar increase adds $150 million to that loss. Now project to $75. At that level, the loss would be $50 per ounce. That's $7.5 billion on a 150 million ounce position. These numbers aren't abstractions. They're real losses that must be covered by daily margin calls. The bank must deposit cash or securities with the clearinghouse to cover these losses. Even for a bank the size of JP Morgan, billions in daily losses create enormous pressure. Here's what makes this different from normal trading losses. JP Morgan can't just exit the position. The market isn't liquid enough to absorb 150 million ounces of short covering without sending the price into the stratosphere. They're trapped in their own position. This is called a liquidity trap. And in commodity markets, it can be fatal. The concept of a gap is crucial to understanding what could happen Monday. A gap occurs when the opening price of a market is significantly different from the previous close. This usually happens when important news breaks while markets are closed or when orders accumulate over the weekend. In silver's case, multiple factors are converging to create conditions for a massive gap higher. First, Asian markets open before Western markets. Sunday night New York time, Shanghai, Tokyo, and Hong Kong start trading. If Asian buyers see an opportunity, they can push the price higher before Wall Street even wakes up. Second, traders holding short positions over the weekend are nervous. They know the price can move against them while they sleep. Many will decide to cover their positions at the opening, creating a wave of buying. Third, trading algorithms react to technical signals. Friday's close at a new all-time high triggers buy signals in numerous automated systems. The technical confirmation of a $75 target comes from multiple sources. Analysts using Fibonacci extensions, a standard technical analysis tool, identify $75 as the next major resistance level after breaking $67. Moving averages in strongly bullish configuration suggest momentum remains with the buyers. Trading volume during the recent rally confirms this movement is supported by broad participation, not just a few large buyers. But the most revealing element is physical market behavior. Backwardation, a situation where the spot price is higher than futures prices. This has persisted for weeks. It indicates acute shortage of metal available for immediate delivery. Premiums on physical coins and bars have reached record levels. Delivery times have extended. Refineries are running at full capacity but can't meet demand. All these signals point in the same direction. The physical market is dissociating from the paper market. For JP Morgan, this dissociation is the worst possible scenario. Their short position is based on the ability to roll contracts indefinitely, hoping the price will eventually fall. But if holders of long contracts start demanding physical delivery, the house of cards collapses. There simply isn't enough metal in COMEX vaults to satisfy all open positions. The ratio between paper and available physical metal is estimated at 200 to 1. Some analyses suggest even higher ratios. The U.S. Defense Production Act adds another layer of risk. If the government decides silver is critical to national security, and recent designations by the U.S. Geological Survey suggest exactly that, it could prioritize military purchases over civilian deliveries. COMEX contracts could be cash settled rather than physically delivered. For short sellers, this solves nothing. They'd still have to cover their positions, but at even higher prices because the physical market would be even more constrained. Silver is critical for solar panels, electric vehicle batteries, 5G infrastructure, military electronics, missile systems, radar equipment. In a world of increasing geopolitical tension, strategic metal control is a national security. The government has already invoked the Defense Production Act for other critical minerals. Silver could be next. This isn't the first time massive short positions have imploded. In 1980, the Hunt brothers tried to corner the silver market. They accumulated massive long positions. The price went from $6 to $50 in months. Then came the crash. They lost billions. But this situation is different. The Hunt brothers were trying to manipulate the market higher through accumulation. Today's move is driven by fundamental supply deficit and industrial demand. In 2008, Volkswagen briefly became the world's most valuable company during a short squeeze. Porsche had secretly accumulated a controlling position. Short sellers were trapped. The stock went from $200 to over $1,000 in 2 days. In 2021, GameStop showed how retail traders coordinating on social media could squeeze institutional short sellers. The stock went from $20 to $483. The difference with silver, this isn't a meme. This is a market in structural deficit for 5 consecutive years, with exponentially growing industrial demand and supply unable to keep pace. China consumes approximately half of global industrial silver demand. Customs data reveals record imports. If China decides to build a strategic silver reserve, as they have done with copper and other metals, available supply for the rest of the world would shrink drastically. In the context of growing trade tensions, using resource control as geopolitical leverage isn't an abstract hypothesis. It's a strategy China has already employed with rare earths. In 2010, China restricted rare earth exports to Japan during a territorial dispute. Prices skyrocketed. Industries were paralyzed. The message was clear. Strategic metals are weapons. Silver could be next. Here's how Black Monday unfolds. Sunday night, New York time, Asian markets open. Buyers seeing Friday's record close place buy orders. Price starts climbing. Asian short sellers panic and begin covering positions. Price accelerates. When European markets open a few hours later, silver is already significantly higher. London traders see the momentum and join the move. At New York Open, the price has already gained several dollars. Algorithmic trading systems detect the breakout and trigger automatic buy programs. Margin calls rain down on short sellers. Those who can't meet them are forcibly liquidated, adding even more buying pressure. The price hits $75 before the end of the day. This scenario isn't science fiction. It's exactly what happened in other markets under similar conditions. The GameStop squeeze of 2021 showed how overextended short sellers can be crushed by coordinated buyer action. The difference with silver, fundamentals support the move. This isn't a speculative bubble based on memes. It's a market in structural deficit with exponentially growing industrial demand and supply unable to keep up. Historically, the bank has used its size and influence to manipulate prices lower when under pressure. The Department of Justice documents reveal decades of this practice. But current dynamics seem different. Physical buyers, particularly industrials who need real metal for solar panel and electronics production, cannot be deterred by paper manipulation. They'll buy the metal regardless of price because they absolutely need it. JP Morgan has essentially three options. Option 1, cover the short position gradually. Problem, the market isn't liquid enough. Any significant buying would send prices higher, triggering a feedback loop. Option 2, hold the position and hope for a price collapse. Problem, what catalyst would cause that? Industrial demand isn't disappearing. Supply deficit isn't resolving. Option 3, negotiate a settlement with regulators, declare the position systemically important, and get government assistance. Problem, political fallout would be enormous. None of these options are good. For individual investors, the practical question is how to position. Physical metal offers ultimate security but lacks liquidity. You can't sell a silver bar at 2 a.m. when the price gap's higher. ETFs offer liquidity but carry counterparty risk. If the ETF doesn't have the physical metal it claims, you're holding paper just like JP Morgan's short position. Mining stocks offer leverage but are subject to operational risks. A mine in political turmoil or facing environmental issues can underperform even in a bull market. There's no universal answer. Each investor must assess their risk tolerance, time horizon, and objectives. What's certain, the status quo cannot last. Massive short positions from JP Morgan and other commercial banks are incompatible with a market in structural deficit. Something must give. Either short sellers capitulate and cover their positions, triggering a historic short squeeze, or the paper market completely dissociates from the physical market, creating two distinct prices for the same metal. Or government intervention forces an orderly settlement. None of these options favor short sellers. For years, traders learned that shorting silver was a profitable strategy. Banks were always there to defend certain price levels. Rallies were systematically countered by massive paper selling. But this psychology is changing. Repeated failures of suppression attempts have eroded short seller confidence. Each new high that isn't immediately reversed reinforces the conviction that something fundamental has changed. Psychological momentum is now with the buyers. Financial media are just beginning to cover this story. For the general public, silver remains an obscure metal, less glamorous than gold, less exciting than cryptocurrencies. But this relative obscurity is precisely what creates the opportunity. When mainstream media start talking about silver, when TV analysts recommend buying, the move will already be well advanced. Forward-looking investors position before the crowd, not after. Although they don't generally buy silver directly, their monetary policy profoundly affects the market. Low interest rates reduce the opportunity cost of holding precious metals. Quantitative easing creates concerns about fiat currency devaluation. Investors seek real assets to protect their purchasing power. Silver, with its dual nature as both precious and industrial metal, benefits from both trends. Since 2020, central banks have expanded their balance sheets by over $10 trillion. That's $10 trillion of new currency chasing a finite amount of real assets. Silver production is approximately 1 billion ounces annually. At $70 per ounce, the entire global annual production is worth $70 billion. That's 0.7% of the $10 trillion in monetary expansion. A tiny fraction of that liquidity flowing into silver could send prices exponentially higher. The Silver Institute's data shows the market has been in deficit for 5 consecutive years. 2020, 51 million ounce deficit. 2021, 82 million ounce deficit. 2022, 237 million ounce deficit. 2023, 184 million ounce deficit. 2024, projected 215 million ounce deficit. These aren't small numbers. They represent 10 to 20% of annual production. Where does the silver come from to meet this deficit? Above ground stockpiles, investment holdings, recycling. But these sources are finite. Eventually, they run out. When that happens, industrial buyers are forced to bid against each other for available supply. Price discovery becomes violent. We may be approaching that inflection point. The next 72 hours are critical. When Asian markets open Sunday night, we'll have the first indications of direction. Traders worldwide will be watching the same screens, analyzing the same data, making decisions that collectively determine whether the Black Monday scenario materializes. For those positioned on the right side, this could be the beginning of a historic move. For JP Morgan and other short sellers, this could be the beginning of the end. Financial history is full of examples of positions that seemed impregnable until they weren't. long-term capital management, Barings Bank, Bear Stearns, all destroyed by positions that went wrong. JP Morgan is obviously much larger and more diversified than those examples. It will likely survive this crisis. But losses on silver could be large enough to affect quarterly results, capital ratios, and the bank's reputation. In an industry where confidence is everything, multi-billion-dollar losses on a speculative trading position don't go unnoticed. The message for attentive observers is clear. The silver market is at a historic inflection point. Forces that have suppressed prices for decades are losing their grip. Physical demand is overwhelming paper manipulation. Fundamentals are retaking control. And when that happens in a market as small and constrained as silver, movements can be explosive. A gap to $75 isn't just possible. Based on technical models and current market conditions, it's probable. The only question is exact timing. And that timing could very well be Monday.